Then today I would like to explain about accounting for merchandise operation. So because we cannot make offline class, therefore I try to create this learning, this online learning so that you can understand for today's material. Okay, now let's start from the cycle of merchandising operation. So the example of merchandising operation is Amazon, Walmart, or in Indonesia it's just like Alfamart, and then Superindo, Jogja, you name it. So every single corporation that do not create their own goods but they trade it in the form of product, it's called merchandising business or merchandising companies. So they buy and sell goods without making by themselves. The primary source of revenue is referred to as sales revenue or sales. Okay, so the basic difference between profit, oh sorry, between service company and merchandising company is located in the cost of goods sold and gross profit. They are not used. These two are not used in the service business. So in merchandising operation, you have to know how much they earn, and it can be known from the sales revenue. And then you have to know the information about the cost of goods sold, which from these two you can get the gross profit. And when you deduct the sales revenue from cost of goods sold, you can deduct it again with operating expense to get the net income or loss. The cost of goods sold is the total cost of merchandise sold during the period. Okay, so this is the basic accounting cycle that you have to know. In service company, it starts from cash and you have to perform services, and then when the client pay to you, you will get cash. While in merchandising company, you cannot earn cash without buying inventory first. After buying inventory, you will get inventory and then you can sell it. When you sell it, the client uh, will give you money at the end and you will earn cash. So the operating cycle of a merchandising company ordinarily is longer than that of a service company. Okay, so the flow of costs for cost of goods sold is you need to know how much is your beginning inventory, and then you need to know also the cost of good purchase so that you know how much you have to record for cost of goods sold and how much is still at an ending inventory. Companies use either a perpetual inventory system or a periodic inventory system to account for inventory. So there will be two type of inventory system, and the company normally will choose whether it's perpetual or periodic. Okay, first we will try to introduce what is the perpetual system. The perpetual system maintains detailed record of the cost of each inventory purchase and sale. It records continuously show inventory that should be on hand for every item. So it's like they will give you information on the precise on detail precisely every time you want to know how much is the inventory on your hand. Okay, and the company will determine the cost of goods sold each time a sale occurs. While on periodic system, you do not keep detailed record of the goods on hand, so you have to calculate how much is your cost of goods sold on the ending period. Okay, what is the advantages of the perpetual system? It's traditionally used for merchandise with high unit value and show the quantity and cost of the inventory that should be on hand at any time. So anytime you need to know how much is the inventory or how much is the cost, you can know exactly on that day or on that time. And it provides better control over inventory than a periodic system. Okay, you can create the exercise on this do it one in your own time. Okay, so I will not explain about it because it's just a review from the previous things that I already told you. Okay, now how to record under a perpetual inventory system. Okay, so uh, in purchasing, we can use cash or credit. So if we use cash to purchase, it means that our cash is decreasing. Or if we would like to pay it on account, it means that we will pay it on another time, and on that on the by the time it's occur, you have to put it on credit. It means your account payable will increasing. It normally records when goods are received from the seller, and purchase invoice should support each credit purchase. Okay, so this is the invoice number 731 here is explain about the example of purchase record, or yeah. Okay, as you can see here, the illustration here, the Sock Stereo is the buyer, and they use a purchase invoice. The sales invoice is prepared by PW Audio Supply, which is the seller. So this is the seller, this is the invoice, and this is the seller. So how to prepare the journal entry for this invoice? If we were taking the perspective of the buyer, which is Sock Stereo, therefore, every time we create purchase, we will put it as inventory because our inventory is increasing. Every time inventory increasing, we have to put on the debit side. While because here it said that we don't pay it immediately, because here there's term 2 per 10 and per 30. It means that we bought all of this item on account. Therefore, we cannot create cash here, but account payable. So inventory in debit 3,800, look at this amount, while the credit side is account payable, this amount. Okay. What about freight costs? Okay, before we go to freight costs, you need to know what is freight cost. Freight cost is it's just like you have to pay for the delivery cost. Okay, there are two type of freight costs. First is freight on board shipping point here, and the second one is freight on board destination. What is the difference between these two? FOB shipping point or freight on board shipping point, buyer will pay freight costs, while on a freight on board destination, the seller will pay for freight costs. Freight costs incurred by the seller are an operating expense. Okay. So if we took the illustration from the previous example, we can create journal both from the Sock Stereo side or PW Audio Supply side. For example is the delivery of the goods on May is being paid by the buyer, which is Sock Stereo. So the entry on Perpetual will be inventory on debit side and the cash on credit side. Why does we put it as inventory? Because in Perpetual, every time we pay for the freight, it will increase the value of inventory. That's why on the debit side, it's not freight cost, but it's inventory. However, because we pay it on cash, it means our cash decreasing. Thus, we have to put the cash on credit side for 150. Okay, so the second example is about PW Audio Supply. For PW Audio Supply, because they are taking from the seller side, it means when they pay for it, it becomes their expense. That's why the debit side will be freight out, while the credit side is cash. Okay, so if the buyer have to pay for it, it will increase their inventory, while when the one who has to pay for the freight cost is the seller, it means it will increase their expense. So the journal will be different if the freight cost is paid by the seller or by the buyer. So, just like sales, had, if we already create purchase transaction, we can also return it and make it allowance. So, purchaser may be dissatisfied because the goods are damaged or defect or inferior quality, or simply because it do not meet our specification. We can return the purchase. Okay, every time we create purchase return, it means the return goods for credit if the sale was made on credit, or for a cash refund if the purchase was for cash. While for purchase allowance, it may choose to keep the merchandise if the seller will grant a reduction of the purchase price. Normally, the transaction belong to purchase return. So, the purchase return transaction is usually done by the buyer who's unsatisfied with the goods. Okay, so this is the illustration for purchase return and allowance. For example, we're taking the first example of stock stereo that returned the goods. The cost is $300 and they return it to the seller, which is PW Audio Supply. So what journal you have to do? It means when we return the goods, it means the inventory is out from the company. So because the inventory decreasing, you have to put on the credit side. And remember that the first transaction is made on credit, right? So because it's on account, it means do you have to pay for the goods that you return? The answer is no. That's why the account payable will be on debit side because it's decreasing. While on the credit side, it's inventory because your inventory is also decreasing. Liability decreasing, you have to put on debit, while when your asset decreasing, you have to put it on credit side. Okay, this is the question that you can answer by your own at home. So you can try to evaluate whether you understand or not within the material by answering this question. Okay, now what about discount? You have to remember the credit term. You already learned about the credit term on the first half semester, which 2 per 10 and per 30, for example. It means 2 per 10, it means they will give you 2% discount within 10 days, or you have to pay for all of the transaction or all of your debt in 30 days. So the credit terms may permit buyer to claim a cash discount for prompt payment. The advantages is you can save money, and seller will shorten the operating cycle by converting the account receivable into cash earlier by giving the incentive of discount. Okay, so this is the things that I already mentioned you before. While this 1 per 10 EOM, it means you will get 1% discount if paid within first 10 days and of next month. While here, the N per 10 EOM, it means net amount due within the first 10 days of the next month. Okay, there is no discount allowed here. Okay, so this is the illustration for purchase discount. Assume that Soxteria pays the balance due of 3,500, while your gross invoice price of 3,800 will less purchase return and allowance of 300. It means 3,800 deducting by 300, it becomes 3,500. Okay, so it will be the last day of the discount period. Prepare the journal. So the journal will be account payable to inventory and cash. Okay, account payable supposed to be in full amount here. 3,800 deducting by 300 2,500, while the inventory here is the number of discount. 3,500 multiplied by 2% is $70 here. The cash will be the difference between account payable and the discount. It means it's only they need to only to pay 3,430 because this is the rest from the account payable deducting by discount. Okay, so here if they fail to take the discount, it means they will have to pay in full amount. Debit is account payable and cash is also 3,500. All right. So, should discount be taken when over? The the answer is yes. 70 and here, yeah. Okay, for do it too, you can do it by yourself because I will not explain this. This is only to evaluate your understanding about this material. Okay, now how to record sales under perpetual inventory system. So we can use the same illustration. However, at this time, we will put our perspective as the seller. Okay, sales revenue is like service revenue. It's recorded when the performance obligation is satisfied. And we can also create sales by using cash or credit or on account. The performance obligation is satisfied when the goods are transferred from the seller to the buyer. The sales invoice should support each credit sales. Okay, this is the basic journal to record sale. First, the journal will be cash or account receivable to sales. This is um, to record selling. Okay, this amount is amounted of selling price. Okay, and the second transaction, you have to record the cost of goods sold from the transaction. So the second transaction will be recorded as cost of goods sold on debit side and inventory on credit side. This amount is as much as their cost. Okay, this is an example of recording sales of merchandising. PW Audio Supply record the sale of 3,800 on May to Sock Stereo. So this is exactly the same transaction. At first, we are pretending to become Sock Stereo or the buyer side, while on this scenario, we acting as a sales, which is PW Audio Supply. Okay, so what type of journal we should create this time? We need to create two journals. The first journal will be recorded as the to record the sales, while the second journal we have to record the costs. Okay, so first journal will be account receivable to sales revenue for 3,800. Okay, while the second transaction is recording the cost of goods sold, and the credit side inventory for 2,400. You will always be told the cost of the inventory. Okay, now sales return and allowance. It's the flip side of purchase return and allowance. It means when someone return the goods that already bought in your store, it means from that side they making purchase return, but on your side as a sellers or as a sellers, it means it's sales return. Okay, so the contra revenue account is sales revenue, but you have to put on the debit side. Okay, sales not reduced because would obscure importance of sales return and allowance as a percentage of sales and could distort comparison. Okay, this is the illustration from the sales return that made by the buyer. So what you have to create, first you have to create the return from the sales and the return from the cost. Okay, so the sales return and allowance is always on the debit side while the account receivable is on credit side. Why account receivable? Because you have not made any payment. Okay, while the second transaction is to record the inventory and the cost of goods sold. It's just flipping the transaction from previous transaction. The inventory is returned, so it means our inventory is increasing put on the debit side, while the cost of goods sold is we have to put on the credit side because there is no cost of goods sold because the transaction is cleared. Okay. If the return goods were defective, so this scenario is we assume the goods were not defective. However, if it's defective, it means we cannot create the same journal. The first journal is the same, sales return and allowance put on the debit side, while the account receivable put on the credit side. The different things is on the second transaction. The second transaction, the journal is exactly the same, but the different thing is the value. So here, the value is 140, as much as the cost, while here, the value is the same like the scrap value of $50. Okay, now sales revenue is always on the credit side, while the sales return and allowance and sales discount is always on the debit side. It means the value of sales return and the value of sales discount will be contra or deducting the sales revenue. So here you can say that the net sales will be 3,430. This amount comes from sales revenue minus sales return minus sales discount. Okay, this is another scenario for sales discount. Assume that Sock Stereo pay the balance due of 3,500, while the gross invoice is 3,800 and you get return for 300. Okay, so on May, the last day of the discount period, you receive the payment from the buyer. What is the journal? The journal will be we will get cash, right? But how much is the cash? We don't know yet because we need to calculate the sales discount first. The sales discount will be 3,800 minus 300 here, and we have to multiply by 2%. Why 2%? Because the credit term said that we will give the sales discount if they can pay in 10 days after the sales. We will give 2% discount. The account receivable always on credit because they pay for their debt, and we get cash, and the how much how much we receive cash. It means the amount of account receivable deducting by sales discount. Keep in mind that the account receivable value is always the same with the one that we create before. See here. Here, the account receivable we create is 3,800 minus 300, which is 3,500. And we also put here as 3,500. Then we calculate the discount. 3,500 multiplied by 2% becomes 70, and we will get cash of 3,430. Okay, we will continue the adjusting entries next week. If you have any question, you can ask through the Google Classroom, and I will try to explain it again once more so that you can understand the material. Don't forget to do the assignment. I will close the assignment on Wednesday at night. Okay, see you.